Good afternoon, everyone. Welcome to another one of our Wednesday webinars. My name is Stock Darts, and as usual, we're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we'll take a quick look at the US dollar, see what it's doing. It's actually had a pretty interesting move over the last week or so. See how it's affecting gold and silver and oil, which have also had some pretty big moves over the course of the last week or so. If you guys like what you see, you can follow me on Twitter. I forgot to put up the graphic, but it's the name Stock Darts. You can find me on Twitter. You can find me on YouTube. I usually upload the recordings of these on YouTube, and I also upload them onto my Patreon page. If you just go to patreon.com/stockdarts, you could find me there. You could find some extra blog posts and trade ideas that I post on there as well. Other than that, we can go ahead and get started with a look at the S&P 500 and looking at the ETF SPY. And as you can see, we had a big move yesterday, and while today's move doesn't seem that big, it actually accomplished quite a bit on a couple of the major markets, and one of them being the S&P 500. Last week, we were looking at a possible bear flag printing. We had these two this hammer candle and this doji above the 200-period moving average, and then we ended up closing very weakly. And then we started the week off again very poorly on Monday, with some news affecting the Nasdaq in particular and the FANG stocks. And we opened pretty low. And then we did have some buying as the day went on. And I actually put on my Patreon page that I suspected we were going to get a bounce, just based off of the price patterns that I was seeing. Despite the negative start to the week, it looked like we were actually going to bounce and try to rally during the week. And that's sort of occurred over the last couple of days. And I think we've reached a point now where it'll be interesting to see exactly what we do from here, because I expected the bounce to head up into resistance, and then how we dealt with that resistance, I think, was the real key. And it's a little bit of a mixed bag. It looks good on the S&P 500. It looks good on the Russell 2000. But on the Nasdaq and the Dow, it doesn't look quite that promising. And we're going to analyze all four of them separately, and then once we see that, we can try to get a better picture of what the market's doing in general. Once we get all four of them out of the way. So again, the first one we're looking at is the S&P 500, and we're going to zoom in a little bit. And the big key right now is that we're actually above 280, which is a pretty significant price point, and it's breaking a couple of different technical indicators that are kind of important for us. One of them being this red trend line, showing that maybe we are breaking through and sort of ending this sort of descending sentiment, or this bear sentiment that first appeared as we printed new all-time highs back in May, right? And once we did that, we started to slowly pull back, and in a pretty orderly manner. You can see the channel, right? We've had a very nice orderly pullback. It hasn't been anything overly crazy. I know it has been a pretty significant drop if you think about it, from 295 all the way down to about 273. But for the most part, it's been in a pretty orderly manner. We've had some nice little sort of retracements in between, and it really wasn't until Friday and Monday that we started to see some acceleration of the selling. You can see volume pick up. We looked at the volume pattern last Wednesday as well, and I mentioned that volume was declining as we were pulling back. And then we finally had a little bit of a volume spike at the end. And a lot of times, I know volume is kind of a tricky thing to interpret, and a lot of people have trouble with that. But a lot of times, if you see volume coming towards an end of a move, that's usually a nice sign that maybe you're finally getting sort of the end of the move, rather than really it accelerating too much further. And so hopefully that was a sign that we found some capitulation, we found some support here, and we found enough of an exchange where buyers stepped in and are trying to control the markets again. Now, I think it's still up for debate as to whether the buyers are back in control and ready to push the market back towards its recent highs. Because again, we're seeing a little bit of a mixed bag, and today's breakout at the moment isn't particularly convincing. I mean, yes, we're above that red trend line and we're above 280, but we'll see how we close the day, and we'll see how we start the day tomorrow, and then from there we could get a better sort of evaluation of exactly where the market is, and whether the price action is strong enough to continue climbing upwards. I do think that this is pretty strong and pretty positive, just to be holding above 280. And if we can sustain the price action here, there's a pretty good chance that we're going to make our way back up towards the 50-pair moving average as well, around 286 to 287. I don't think that at the moment all-time highs are in the cards. I think if we do have a nice bounce, it's probably going to make its way up towards 290, but I doubt that we push past 290 to 292. I don't think that we push past sort of this white, the top of this white box. And again, if we take a look at what we're looking at in a longer term chart, here's a look at the weekly chart of the S&P 500 and the range that we've been trading in for about a year and a half now, almost 2 years. And this 290 area is significant resistance. It's a pretty strong ceiling on the price action, and the character of the price action over the last couple of years while we've been in this range is very interesting because we've had very strong trends even though we've been range bound overall, right? We had the really strong sort of explosion upwards, and then we had a pretty drastic drop. Then we had a very steady trend back up, and then we had a very drastic drop at the end of the year, which actually obviously over-exceeded the expectations and went well below the range. But we were able to get a really quick bounce this year to get right back into that range, and then the bounce this year also was incredibly rapid and incredibly strong as we made our way from well below our trading range all the way back up to the top and even printed new highs on a couple of the indices. And at this point, we're right back to the same sort of pattern where we've turned around and started marching straight downwards. Now, I don't think that at the moment I expect us to march all the way back down and continue this trend. The market likes to fool people, and when you have a trend like this, or you have these patterns, it will often throw a curveball and not necessarily always do the same pattern. So at the moment, I'm not expecting us to come all the way back down to lows, but it certainly is a possibility, and it's something that we need to keep in mind because it's exactly what's happened every single time that we've hit the top or bottom of this range. And at the moment, we're still basically trending downwards, even if we do have this little minor breakout on the S&P 500. I think it's really more a matter of whether this breakout can sustain itself and make its way upwards before we could say maybe we have a different shift in character in the market. Overall, I still suspect that we're neutral and range bound, and I'm still kind of targeting playing more range bound plays. And what that means is on Monday, we kind of do one of these jobs. The market looked pretty weak, and I suspect that a lot of traders were thinking, well, we need to keep shorting this. And I was thinking quite the opposite. I was thinking, no, this is a good time to start to look at maybe playing some longs because of the risk reward and the fact that I think we're range bound. And typically when you're in a range bound market, it traps a lot of traders and it tricks a lot of traders because for whatever reason, the normal inclination, I guess it's basic human psychology, is to be convinced by the last few candles, recency bias, and to want to go ahead and try to go long at the highs and try to go short at the lows. And you tell yourself, well, I'm buying strength or I'm selling weakness, so I'm doing the right thing. And that can be the right case. I mean, I'm not saying that you shouldn't buy strength, but there's a little bit of a paradox in that when you're buying strength, if you're just blindly buying stocks at highs, you're usually getting pretty poor risk reward on it. And from the sense or perspective of timing, you're usually off on that as well. And what I mean by that is that stocks tend to ebb and flow quite a bit because there's always buyers and sellers. And if you're constantly buying at the high point in price, then you can get shaken out with the normal ebb and flow, the normal sort of back and forth that the stocks take just because you happen to buy at the highs. So does that mean you should buy weakness and sell strength? No. What it means is that you should always look to buy value, to find value in a stock. And if you're going to buy strength, you're going to trade strength, you need to do it during periods of consolidation where you could sort of manufacture your own points of value based off of the shorter term ranges that these stocks sort of print out. And so what I've been doing is I've been looking for stocks that, relatively speaking, are strong, but we're setting up at spots of values, points where they had strong support. And even if they pulled back, but they were still holding up well, we're setting up for a bounce. And I think that's really the way to do it. And again, if you're not really sure what I'm talking about, go ahead and visit me at patreon.com/stockdarts, and you can see some of the ideas. Some of those ideas are free. I'm going to put the link there just in case. And that's really how you want to go ahead and play something like this, especially when you're range bound. Is you basically want to buy support and you want to sell resistance. And so now that we've had a bit of a bounce, you have the next situation, which is, are we looking to, do we expect this bounce to continue, or have we already hit resistance where we can start looking at shorts? And I don't think we're ready to look at shorts yet, but I am strongly considering establishing more names in my watch list as far as short plays are concerned, depending on how we navigate through these current levels. And again, I know the S&P 500 looks good, but when we get to the NASDAQ in a second, you'll see it's a little bit different. So as far as the key levels are concerned and what I'm watching on the S&P 500, obviously the key level I've already mentioned a couple times. It's 280, 60 or so, 280.65. As long as we stay above this dotted line, I think we're fine. If you take a look at it, this was a very important and critical level at the end of last year, which we established as a pretty big ceiling in price range. And if you look at what happened this year, this was the only time we really spent consolidating and really struggling to clear an area. If you look at the way we opened this year, we started off strong and just kind of blasting right through all of these potential areas of resistance, right? We just shot right through 255. We spent maybe a week around 263. And then when we got to 280, you can see we spent a week or two below it and then a week or two above it, and then finally made our way up all the way to new all-time highs. Now we've come back to that range. You can see we spent a bit of time trying to hold above it, failed. Then we spent a week or so below it, and now we've made our way right back above it. And so the key is we can hold back above it. That's a significant price level to hold above. And if that's the case, then that means we should flip bullish and continue to look at price trying to climb its way back through its moving averages and towards its recent highs. So overall, this is pretty bullish. And the key level besides 280 is, I think, that the 50-period moving average around 286, and then obviously this 292 or so at the top of our range. I would say the all-time highs, of course, are significant, but I think this 292 area is just as significant at the moment, because we're going to have to kind of go through there again if we want to make our way back to highs. Now, if we fail here and start to pull back, we've established a nice little level of support here, right around the 200-period moving average and just below it, all the way down to 273. And I expect that a move back down to that level should serve as a retest, but if we kind of go right straight back down to that level, that's really not that positive, and there's a likelihood that we continue to kind of go back below that. And if that's the case, we probably continue following this channel down. But at the moment, I suspect that we're going to spend the next few days consolidating right around this 280 and trying to establish the price action holding above that before it starts to make a run at these moving averages that are holding right above it. Now, if we take a look at the NASDAQ, you can see a little bit of a different picture, right? We haven't broken that descending trend line. We're not above that critical spot, this dotted trend line that I drew, and still have a bit of way to go, right? And again, a lot of this is due to what happened on Monday. You can see the big drastic sell-off, and this was due to the Federal Trade Commission investigating all of the big FANG stops for, trying to decide whether they're actually monopolies or not. Or looking at just the different antitrust violations and the way that they've done their business over the years. And my suspicion is that it's going to be something that ends up being just a blip on the radar, and that it ends up being ignored, at least as far as the charts are concerned for now. An actual trial or an actual investigation is going to take a long time to complete. And I think this was just one of these news events that sort of tips the hand of the sellers or the buyers and sort of resets the chart almost from an emotional perspective. So I think that was maybe the culmination of this pullback and probably the end of it. But you can see it was such a big move that it set the cues up at a spot where now it's well below its technical levels that we're looking at, that are basically sort of the same respective price points as the S&P 500. And so while the S&P 500 is already back above a critical level, the NASDAQ is not. And so from the perspective that I was mentioning earlier about whether you want to go ahead and look for possible shorts into resistance or whether we want to continue to play longs as we break through them, well, with the NASDAQ, this is still setting up as a possible short scenario if it can't get back above these two trend lines, the red one and the dotted one. And so in this case, the tech names are still looking a bit weak. And it looks like they need to really clear this before we could go ahead and get behind them and say, well, we want to go long on this spot and we want to go ahead and try to take advantage of the upwards momentum as we make our way back to highs. So this is a decidedly different picture from what we're seeing on SPY. And this is part of the problem with the market. And one of the reasons why I say we're still range bound and why we're still in a neutral environment is because we're getting mixed signals between the four major markets, the four major market indices. And as long as that continues, we should expect a lot of false moves and a lot of back and forth as these stocks and these ETFs start to try to align themselves more accurately and try to make a move together. So the key levels we're looking at on the Qs is obviously 178. We need to get above there before we could really start to get a little bit more excited about a bullish play on it. If we falter here and we roll right back over, then this becomes a very good spot to look at possible short plays, in which case we're looking at the 200 period moving average as short-term support, and then more likely a move back down to about 170 to 171, which is the spot we found support earlier this week, and likely would be a spot where we need to come back and retest if we fail to break past 178. Now, if we do break past 178, then much like the S&P 500, we need to fight these two moving averages, the 20, which is the brown one, and the 50, which is the green one. And I don't expect us to really get past the 50 too quickly. I would expect a lot of sideways price action around that level, and a move to new highs I think is still premature and not something that we're really looking at the moment. I think at the moment what we're looking at with the NASDAQ is to see if we can just establish price action on that side. And I think if we do, it's going to be mostly sideways rather than a swift climb back up. Now, the only way I would change this viewpoint is if we had a big green candle maybe tomorrow that would just surge right through these price points, and that would probably coincide with a strong move on the S&P 500 to get past its 20 and make its way all the way up to the 50. And I think that's not a likely play, but it is a scenario that's possible. I think the more likely scenario is that the NASDAQ spends the next couple of days testing 178 while the S&P 500 tries to consolidate above the same level, which on the S&P 500 is 280 or so, right? So I expect the more likely scenario to be S&P 500 sticks around here, while the NASDAQ sticks around just below that level and keeps testing it. Now, the next likely scenario would be a rollover, which again would be a good short play based off of how it behaves around this point. And if that's the case, then we could look at some short plays and assume that we're still sort of making our way down in the markets. Now, looking at the Dow Jones, you can see that it's very similar to the S&P 500. We have just a bit of enough of a movement to say that we've broken this red trend line and that we've established price back above 254 or so on the Dow, which again is a very similar price point that we want to look at, and from relatively speaking, the same sort of area as the S&P 500 and the NASDAQ. We established these kind of points that we needed to break above last week, and I think that again they're very relevant and they're very important because they're price points that have made a difference throughout the end of last year and the beginning of this year. And again, you can see on the Dow Jones how often we've used this as either a floor or how often it acted as a ceiling. Now with the Dow Jones, it was relatively speaking strong last year, so it kind of went back and forth through that point. But I think it's an important price point that we need to still deal with. And again, very similar to the S&P 500, I expect the next few days that we're going to spend trading sideways, trying to establish that this is a full breakout and that we're not going to roll right back over and continue declining. I think the more likely scenario, again, is trading sideways. But if that doesn't play out, well, then it's probably more likely that we roll right back over and head back down and test this 248 and 246 level. And then the least likely, but still there's a potential chance it happens, is that we just try to blast right past this. And if we do that, we'll get above the 20. And again, probably make our way up to the 50. I don't expect much past the 50 per moving average at the moment. And I think that, again, we're going to find a lot of overhead resistance in this 260 to 262 area and probably stall out there rather than make our way back all the way up to highs, which, again, the Dow Jones didn't even make it to all-time highs like the NASDAQ and the S&P 500 did. Relatively speaking, it was weaker to start the year. It has picked up a bit of strength, and this often happens when the market starts to get a little bit more bearish or sort of fearful, because the Dow names tend to be a little bit safer, and so a lot of times money sort of not necessarily flows to the Dow Jones as much as it doesn't flow out of it as quickly as it does out of maybe small caps or some tech names. And so again, we're seeing a little bit of strength on the Dow Jones, relatively speaking, but overall, it's still doing the same thing where it's just trying to hold up and it's trying to break this downtrend that we've seen establish itself over the course of the last month and a half, starting basically in May. And once we get that break, once we get that full established breakout past this level, then we can expect price action to hopefully stabilize. And again, what we want to see now, if we're looking at the big picture, is we want to see price action kind of stay in this area. This was an idea that we explored a few weeks ago, and really it was something we explored a lot as we approached the highs. Right? If you go back again and take a look at what we've done in the market and how quickly we went from being at new lows and really rolling over on a market that looked like it might have topped out and started entering even bear market territory, we quickly zoomed back to highs. And as we approached those highs, I started warning traders that as bullish as everything looked, the risk reward was not there for us to try to continue buying, that we needed to kind of control ourselves because we were hitting the ceiling of a very broad, very important sideways range. And so typically what you want to see in these ranges is you come up and you test it, and you don't want to come all the way back down and test the lows. You want to establish price action just below there and build up enough momentum to get a sustainable breakout. So what we really want to see right now is we want to see price continue to climb and not necessarily make its way to new all-time highs, but just sort of reside below them and establish momentum and maybe spend out the next month or two, the summer months, building up some momentum to try to rally and try to break through it as we head into fall and as we head into winter. And again, that's, I think, the bigger picture idea and what I'm kind of hoping happens. It may not play out that way, but that's the scenario that I would like to see play out, and the one that I think is most likely to play based off of what we're seeing with these overall patterns. Now, again, one of these days the market is going to roll over, but until it does, we have to continue playing it as if it's doing what it has been doing for the last decade, which is continue to climb. We've been in the midst of a major bull market ever since 2008, 2009. Matter of fact, I'm going to go to the monthly chart and just get a better picture of it. And as you can see, we've just continued to climb ever since we had the big, obviously the crash in 2007, 2008. And until something different happens, we're just going to continue assuming that the long-term play is long until we get enough warning signs, until we get a position where we clearly we're no longer on the same climb. And if you'll notice, the last time we had one of these really broad ranges was 2015 to 2017. And it was the same sort of idea. You spend some time going sideways, and then you'll notice towards the end of that, you start to really just establish price action just below resistance, and then bam, you break out, you hold above that, and then that's when you really start to climb, right? So what we're hoping is that this phase right now that we're starting to work on is hopefully analogous to what we saw right around the middle of 2017, where we started to establish price action just below the ceiling of the range that we were spending a lot of those 2 or 3 years in, right? So that's what we're kind of hoping for. And if that plays out, that's going to be fantastic. If it doesn't, well, then maybe we come back down, we spend more time in a range. Sometimes these ranges could play out for a few years. But overall, as long as the price action respects the boundaries that that it establishes and that we can sort of measure, then we have trades we could take, right? And that, I think, is the key, is to not get overly excited about predicting what the market's going to do. Just understand what kind of behavior it's sort of regulating it at the time, and just go ahead and follow that and react to wherever it goes as far as the ranges and the parameters that are guiding it at the time, right? So that's what we're doing. And with the Dow Jones, again, very similar to the S&P 500, we want to see just that it kind of sustains this breakout, which at the moment is very sketchy. Obviously, if you look at this is not exactly the most confident breakout at the moment, and we need to see a little bit more. But overall, it's still doing something positive. Now, if we look at the last of the major market indices, IWM and the small caps, it actually has a nice breakout. This is actually pretty interesting because IWM has been the weakest by far of the 4 major markets, and it actually is starting to show a little bit of strength. And again, this could be just because it was already so weak that it just needed to sort of react quicker. We were really at a point here where if the small caps fell a little bit lower, well, we'd be outside of that range. If you compare it to what we're the benchmarks that we're looking at on the other three indices, we're still well below those areas, right? As far as I don't even have the dotted line because the price level that we would need to break on IWM is probably all the way up here, 158 to 160, which would be the highs for the year. So relatively speaking, still has to play a lot of catch up, but I like what I'm seeing the last couple of days. We are firmly breaking that downtrend and establishing a nice bottom, which again is very important on IWM because we're at the bottom of that range. Now, of course, technically speaking, you could say, well, the real lows are way down at 125. But if we look at the majority of the price action over the last couple of the years, that we've, 145 has actually been the floor for IWM. Obviously, not counting the big drop that we had at the end of last year. Of course, breached all the major floors that we had across the board. But other than that, this was a key area. If we started to fall back below that, that would have been trouble. That would have meant that we were losing a key range on IWM, which meant that we would have to expect that there's a potential for the other indices to also come all the way back down to the floors of their range and start testing those. So really nice move here, really positive. Still has to do a lot of the same things that the other indices have to do, which is one, clear all their moving averages. You'll notice with IWM, we're still well below the 200-period moving average, while the other indices just kind of tested them now. We're below the 20, we're below the 50. All of them are pointed in the wrong direction. So IWM still has a lot of work to do in order to sort of turn this picture around and start looking more bullish and start to sort of mimic what we're seeing out of the other three, out of the SPY, the NASDAQ, and the Dow Jones. But over the last couple of days, this was a nice transition, a nice little show of temporary strength. The key levels we want to watch, we do not want to see it lose 145. I think that's a major point. And if we lose that, I think we need to sort of reevaluate where we stand in the overall markets, because that would be a very bearish turn of events, even if it is on IWM, which has been weak for quite a few years now, and not necessarily every time it's weak, that doesn't necessarily bring the markets down with it. But again, it wouldn't be a good sign, and it would be a warning sign that we are going to see more selling if we reverse from here and came all the way back down to 145. Now, if we try to make our way higher, what can we expect as far as walls that are going to sort of stonewall it? Well, I think this 154, 155 area, right around where we printed this last little bear flag and right around the glut of moving averages is going to be a key area that we have to break past. And then the big spot is 158, which again is important because this was a very big shift in character in the markets and in IWM in May. We had a very bullish two-candle pattern here, establishing a breakout above a key area, and then we had what turned out to be a failed move with the reversal the next day. And that is, when you see these sorts of things, these are key areas that develop on a chart and become very critical spots that you need to retest and either confirm as a breakdown area or invalidate by being able to breach them and go back in the other direction. So this is a very key area, and I think is the major sort of line in the sand that we need to see on IWM in order to establish a more healthy chart pattern on the small caps. Now, I will say this: if IWM gets past that zone, then I suspect that means the other indices are probably ready to print new highs. And if that's the case, then we should expect a strong rally through there. However, at the moment, that's not what I'm anticipating. I'm anticipating a move up to there and likely a temporary failure as we continue to trade sideways with the scenario that I sort of played out with the other indices. But again, we're getting a little ahead of ourselves. I think right now the major point that we need to watch is how it navigates these moving averages over the next week, maybe even a couple of weeks. As we start to try to climb through there. And the big thing, again, is we just don't want to lose, we don't want to lose this breakout point around 148, but more importantly, we don't want to lose 145, right? And so that's the four major markets. I think overall, if you look at all four together, you can see that we're painting kind of a mixed bag, and it's kind of a neutral, what I would consider a neutral situation, a neutral environment right now, because again, we're not seeing all four of them climb strongly together. We're not seeing all four break down together. We're seeing them in different stages of attempting to bottom and attempting to start to establish a new trend back up, even if it's a retracement of the previous trend. So I think overall, we can expect price action to continue to be a little erratic, and I think we need to continue to sort of play it more cautiously right now and really look for different areas of the market that maybe are establishing different patterns that are either strong or weak, and trade those. And what I like to call a stock pickers market, where instead of kind of loading up with a lot of longs in either, a lot of longs and just adding names to your portfolio, I think this is a situation where you just want to be swing trading in and out, and taking advantage of the range bound nature that we are probably going to be in for the next month or so. Other than that, that kind of covers it. We're going to go ahead and take a look at the U.S. dollar now. We have a pretty healthy amount of people attending today. It's welcome and glad to see you guys here. I love it when you guys come in. I'd love to see some participation. Those of you that are in here, feel free to start putting in some stocks that you're looking at. Let me know if it's a name that you are looking to. It doesn't even have to be a name that you're trading. It could be a name that you are looking to enter, or it could just be a price, maybe a pattern that you're seeing that you're not sure how it works, or if you want to just more, you want me to elaborate on a certain pattern that you're seeing, or it could be a name that you're trading. Maybe you're trying to figure out where you should take profit, or maybe you're down on it and you're trying to figure out where support is. Feel free to put any tickers on there. I'd love to see what you guys are looking at, and I'd love to help out with any answers that you guys might have. Participation from you guys is really what makes these things worth my time and enjoyable for me. All right, so let's take a look at the U.S. dollar with the UUP index. And you can see we had some weakness. And I think this is concurrent with all of a sudden there's been rumors that the Fed might actually lower rates again, which I think is still a little bonkers. And I don't think it's really something that could happen. But I mean, that's the consensus right now, is they're expecting that might happen, I guess, to prop our market to continue to hold them. And the U.S. dollar pulled back. It came all the way back down to the bottom of this range. But while it looks like we've been weak over the last week or so, and it looks like we should bounce at the bottom of the range, that's typical, I'm seeing a bit of a different pattern, particularly on the euro, which might bode poorly for the U.S. dollar in the future. Now, again, if we're just trading UUP, we expect support here and we expect the bounce, which means we should expect the U.S. dollar to bounce over the next few days and try to make its way back higher. However, if we look at the euro, this was a major breakout. And this is a very key level. We've been watching this for a while now, this price pattern. And it did try to break this before and failed, right? So there's always the possibility. You can see the long wicks here as the euro lost a lot of strength today already and could end up heading back lower. But when you compare this and we see what we're going to see in gold and silver, it looks like the U.S. dollar has lost a lot of strength and is possibly ready for a little bit more of a descent and a little bit more of a drop in price, especially versus the euro. And again, I think the euro needed to do this. They were at the precipice of a pretty big breakdown, and they lost a key level. This 113 is a major level. If you go back and you take a look at it historically speaking, since about 2015, that has been a very crucial area that was very important from 2015 to 2017. And then once we had that major breakout, we've kind of come back and retested it finally, and you can see it's been an area of contention for quite a bit, and the price action had eroded enough to kind of fall back below there, but we're finally seeing an attempt at the euro to make its way back up there. So I think ultimately what we can expect in the next month or so is for the euro to make its way back up to 113, 114, and then what happens there is anybody's guess. It could end up being a ceiling again, and it could end up rolling right back over, but overall, I think in the short term, short to intermediate, this is actually bullish for the euro and bearish for the U.S. dollar. Remember, keep in mind, this is because this chart is priced in euros, it's inverse for the U.S. dollar. So down is strong for the dollar, up is weak for the dollar. And you can see in this particular case, this is a big reversal. And while it may pull back and test this, as long as it holds above 112 or so, you can expect the euro to end up being a bullish trade and probably make its way up all the way up to 113, 114 in the intermediate term. Now, if we look at the U.S., we again see a weakness coming in, and a lot like the channel we're seeing on UUP, it looks like the U.S. dollar should bounce here. But overall, this was, again, a big reversal and a failed move, right? We had this breakout, and it turned into a failed breakout. A lot of times when you have these failed moves, they could end up extending quite a bit in the other direction. So if we don't get a strong bounce here, I could see the U.S. Canadian fallen all the way back down to 133 before it finds a stronger foothold and support around that level, and at that point the 200 period will kind of come up and meet up with it. So this is critical if this hammer can hold or not. If it doesn't, if we see more weakness, if we see strength in the euro, then I expect the US Canadian to also pull back and maybe test a bit lower. And then finally we have the US versus the yen. And again, major breakdown, attempting to bounce here at pretty critical support. And again, this one looks a little bit more bullish, right? This is a nice 3-day candle pattern. And I would expect a strong move off of this. But again, how much more can we get? Maybe up to 109.20 or so before we establish, again, strong resistance. And if the US dollar behaves according to what we're seeing across the board, then I would expect this to be a bounce that's maybe short-lived and then turns right back around and comes back and retests these levels. But this is a nice little 3-day candle pattern indicating a possible bounce coming in the next few days. All right, so overall, as you can see, it looks like the US dollar strength is deteriorating, and that has led to a pretty big explosion on gold prices. It's unfortunate last week we looked at this, and I didn't think it was really worth looking at. And this was a trade that I missed quite a bit, and it kind of bugs me because, again, if we go back and take a look at what happened, it was a very nice establishment of a break past this critical range that we've been examining, and from there it just continued to just gap up and higher. Now, it's hit the ceiling already. Judging by the fact that the US dollar looks like it might bounce over the next few days, gold should pull back and establish some sort of consolidation range here. At this point, it's still difficult to trade because it's already back to the top of this broad range, and gold tends to trade in these big sloppy ranges. So at the moment, I don't think that there's any kind of established pattern that we could look at to go ahead and enter a long play on gold. I think we missed this move, and at this point we need to wait for some kind of consolidation range that's easier to trade to go ahead and take advantage of that, or for that matter, SLV. SLV did make its way all the way up to a strong resistance level. You can again see, relatively speaking, it's so much weaker than GLD. I think, again, if you want to trade precious metals, you still want to trade gold. You don't want to trade silver. Well, silver's just too weak, and while it might seem like a better value play, you're really just buying weakness. You're not really buying something that's, in this matter, I think GLD or gold is still the way to go. I think silver, we just need to keep watching it and see if it ever regains strength versus gold. And then the last commodity we want to look at is oil. And oil has actually had a very drastic breakdown. It went way past the level that I expected. I expected to find support here at 54, and instead it just blew right through there. And then as it tried to bounce, it became a strong point of resistance. So overall, we're seeing a big drop in oil. And it actually has come all the way back down to this broad range that it traded for quite a long time. And it'll be interesting to see. I suspect it finds support pretty soon just because these kind of declines don't continue forever. But at the moment, I think if it does find support, you now find this 54 to 55 to be a strong point of resistance. So overall, oil is really starting to lose a lot of momentum. And until it starts to establish the next round of support, we might as well just stay off of it, because at this point, even if it does bounce, it's going to be a bounce right up into resistance. So we want to see some kind of an established reversal pattern before we want to try to play to the long side. And if you want to short this, I think, again, you want to see a bounce into resistance, at which point we could take a look at possibly shorting it back in the other direction. But that's not really the case at the moment. All right, so that's oil, gold, silver. Like I said, we have a little bit of time for chart requests. If any of you guys have something, I'd love to see what you guys are looking at. Wes, you look at, ooh, Janko, I haven't seen solar companies in a while. You're up 18%, looking for levels to take profits. All right, so nice trade on this, Wes. That's actually a pretty good spot. Let's look at the weekly chart. All right, so This looks like a kind of important price level here. It was 23, 24 bucks, just below 25. Again, looking back, this is quite a long history of Genco. And prices obviously fluctuated back and forth through there, but you could see it was, for the most part, a floor way back in 2011 to 2012. Then we broke down, we came back up, and that became an important price. And then it was an important price again back in 2017, 2018, before we broke down. And as we've made our way back up, you can see, I kind of change this back. Let's change this back to my normal trend lines. I want to do a couple more, just big picture. I want to analyze the big picture of what's going on here, right? All right. You can also, if you take a look at it, this is kind of an important area. And the reason I say that is that was where we also came down as a floor. And then it's established right here. This was a critical breakout or breakdown. And then again up here. So $20 is critical. And it looks like 24 to 25 is critical, right? So we go back to the daily chart now. And we see what's going on here. I'd say 24 is probably your target at the moment. Obviously today's candle is not that great, but this is a very nice breakout. You notice we had 1, 2, 3, 4, 5, 6 green candles in a row, and they were expanding. One thing I've noticed, especially if you're trading options, right? And I'm not sure if you're trading options here because you're only up 18%, but when I trade options, a lot of times if I see 2 or 3 big green candles, when I see candles like this and I see them expanding, I usually take partial profits on that third expansion candle, because I notice that a lot of times what happens is when you get that big move, it doesn't end the move, but you get a consolidation after. So there's a chance that we're going to get a little bit of a consolidation here, but I think ultimately the target you want right now is 24. I think that's the critical level if you go back and take a look at the longer term charts, and is probably about the spot that I'd want to go ahead and really kind of target as my profit point. Now, you could hold for a move past that, but I think that would be the initial point that I'd be targeting for a nice play. And again, I think you probably entered here, which means you know, if I would have entered down here, then I would have looked at 21 as my first point, but it already blasted through there. And so I think at this point, that's probably the area you want to look at. You entered on May 10th. Oh wow, so you've been in it for a while. All right, so yeah, so you had to hold it through a bit of a mess, and you finally got that nice move. And yeah, I would 24 is basically what I think is the kind of the critical level here. Again, I think if you look at the weekly chart and you see what it's done and where it's going, that looks like the likely spot for major resistance to sort of turn up. Now, keep in mind, of course, when I draw a trend line, these trend lines, it doesn't mean that all the resistance is up here at 23.96. Usually these things play out as zones, right? And that's why you can see it started to sell off as soon as it started to reach this point. And the reason for that, of course, is that these trend lines are representations of human conceptions, right? This is basically what people consider to be a high price or a low price, depending on what side you're looking at. And not everyone is going to wait for 24 on the dot or 24.30 or 22.36 or whatever. What's going to happen is as you approach this, you're going to have some people that want to get in ahead of the move, and you're going to have some people that are cautious and want to wait till after. And that's why a lot of times you get a lot of fluctuation through a trend. And so I think that's one of the keys to understanding trend lines, is understanding that what this trend line tells you is not necessarily, we're not just connecting dots on a chart. If that's the case, then I'm doing a very poor job of connecting dots, right? Because I'm missing by quite a bit. And I think a lot of people get overly concerned with this, and they'll be like, well, I want to connect every dot, right? So they'll do it like this, and I'll be like, this is the right trend line, not the one you drew. And depending on what you're looking at, that could not be the case. But I think it's more important to understand when you draw a trend line, what you're doing is you're trying to represent human emotion and human behavior. And what you're trying to establish is what people consider to be points of value on a chart, or you want to try to define what sentiment is, right? So in this particular case, I'll draw this, and it's crossing through a lot of points on the chart. But the reason for that is just that just below 17 seems to be a price that people thought Genco was worth buying, whether it's institutions, whether it's individual traders, whatever it is. And you're going to have some that want to buy ahead of time, and you're going to have some that wait till the break and come back and then buy it after. That's why you get a lot of zigzagging back and forth through there. Same thing here. On the upside, you're going to have these trend lines, and you're going to have possible breaks or possible moves through them. And you have to kind of, when you're drawing these trend lines, again, don't focus too much on connecting all the dots as much as understanding the significance of what that trend line is supposed to represent. And so in this particular case, this 24 area is important, but keep in mind, it could be just a bit below it or just a bit above it, because a lot of times people are going to jump in ahead of the move. And that's why you saw some selling off today, even though it hasn't quite reached that level yet. It's because people are jumping in ahead of time to try to get there before you. Now, I think ultimately it still tries to make its way to 24, so you can afford to be a little bit patient. But I think it's going to probably take a consolidate before trying to make its next move. So we'll see what happens. But that would be the level that I'd be looking at. All right, anyone else? Kind of interesting. I haven't looked at solar names in a while. You can see 10, which is the ETF for solar names, also having a nice move as well. Wonder if that's just inversely an inverse move to oil. Looks like it's a critical level it hasn't broken past yet. Ron, you're looking at AES. Well, here's the weekly chart, so let's look at that first since I was already on the weekly. So overall, it's at support, right? By the way, I put this in Patreon for those of you that are members, or for those of you that go ahead and take a look at my Patreon posts. I put it. One of the things, or one of the notes I had on Monday was to always take advantage of looking at extra time frames. And you may or may not notice that. I think that's actually one of the quote-unquote secrets to trading that a lot of traders ignore, or they get lazy and don't focus on, is sometimes when you look at a chart, it might look one way on a daily chart, and then when you look at it on the weekly, it looks completely different. So usually it really helps to go ahead and take a look at the different perspective of it and look at it from a different time frame. Whether it's the weekly chart, whether it's maybe a 30-minute or an hourly chart if you want to try to get a closer look at it, and try to get a better view of it. You'll notice a lot of times with a chart, I'll drill out, or I'll go out and I'll take a look at the weekly first and try to see what the broader strokes are as far as what the stock is doing, and then from there I'll make my way back down to the daily and then see if I can figure out exactly what's going on with it from that perspective. And I think that's one of the real strong habits that a trader could get into. And a lot of times we get lazy and we don't look at the weekly chart, or we just kind of look at the daily and just say that we call it a day at that. And sometimes it makes the biggest difference to just go ahead and look at the weekly, and it'll either validate or invalidate something that you're seeing on the daily chart. So it's kind of critical to watch. In this case, didn't make much of a difference other than letting us know that this is actually a pretty good support zone, and it's attempting to I guess double bottom here. Now, your question is it worth a try here? And I think that it was worth a try yesterday. Obviously, in hindsight, that's easy to say, but if you look at the price pattern, this is very similar to what I just pointed out earlier with these three candlesticks on the US-Japanese yen, where you have sort of a trio of hammers at a good support level. Now, the problem with today is if you buy it now, where's your stop? Your stop's way down here, 1560, right? So you have almost $1 stop. And what is your profit target at the moment? Because, I mean, it's easy to say, well, my profit's 1836, so I think that there's still good risk reward. But the truth of the matter is that you're going to find find a level of, you're going to find some resistance up here at just below 17. And then you're likely going to find the next level of resistance just above it as it starts to try to break this descending trend line, as it starts to try to break this 50-pair moving average. And so it's going to struggle a bit around that price, okay? So give me 1 second. All right, sorry about that. So if you really think about it, you've got about 80 cents to the downside, and what do we have to the upside? I mean, 40 cents up to this level, and maybe another 70 cents up to the descending trend line and up to the 50-pair moving average. So I think at the moment, it's probably not worth a try. I think it wants to make its way up to 17. I think that much is clear. And it had a nice bounce here. So I think it depends on your time frame, and it depends on what your ultimate goal is on this stock. If it's just a swing trade, I think that you're probably late, right? And again, you're not too late on it. It just today's move was really strong, and it left it at a spot now where the risk reward is really not that great. And if ultimately your goal is to hold this for a few months and for it to sort of continue to break through these this overhead resistance and make its way higher, then yeah, it might be worth a play here. But if you're just looking at a short-term swing trade, then I think you're not at a spot where it's conducive to a high probability trade or a trade that's really worth your time as far as the risk reward is concerned. I think if you would have traded it yesterday, after yesterday's close over 16, then I think yesterday around the close that would have been a great spot to go ahead and enter, because then you're looking at maybe, what is that, 30 cents, 40 cents of downside, and you're looking at nice 60, 70, 80 cents of upside, conservatively speaking. Obviously you can hold for a move all the way up to 1750, 1780, 18, and if that's the case, then the entry here is not that bad. But if you're just looking for a move back into this area, then I think that you're late. So I think a lot of it depends on what your ultimate goal is again. Now, if it comes back, and this is, by the way, another important thing to keep in mind here. When a name comes up, like, so you just said, okay, you're going to pass. It came up on some kind of scan that you have, right? Just because something doesn't look right at the moment, or because you missed it or whatever, that doesn't mean that you just discard it, right? Just put on a watch list. I sometimes try to kind of curate these different watch lists depending on what I'm looking for. And something like this, if it pulls back into a nice little orderly bull flag here, then the risk reward becomes a little bit easier for you. And it doesn't have to come all the way back to 16. All it has to do is establish a new point for you to stop out. It could be something like this, where once it establishes a consolidation range, you can tell yourself, well, if it loses this consolidation, it's going to make its way all the way down here, so I might as well just stop out there, at which point you have a better risk reward for a move back up to that, right? So sometimes in these situations, all you want to do is just basically look for, put it on your watch list, and maybe it sets up in another 3 or 4 days, maybe it sets up in another 2 weeks, maybe it sets up in a month, maybe this stays on your watch list for the next month and a half, and then it ends up doing something like this, where eventually you get to trade it as it breaks this major zone above 17 and above this trend line, right? So this is still worth keeping as a watch list name to see what it does in the future. I just think as far as where it is right now, today, speaking of today, it's not a great entry right now. Again, just because you kind of missed 40 cents or so on what is probably an 80 to 90 cent move. Okay, I think that's kind of critical. That's one of the things that you guys should pay attention to. A lot of times when I'm looking for building a watch list and looking at names, what I like to do is look at strength, right? So maybe I'll scan for names that are like around their 52-week highs. And some of them will have nice patterns that are actionable, but others will not. And that doesn't mean that you ignore them. If you see something that has the potential of developing a nice pattern in the next month, well, then just put on a watch list and see if over the next month it prints a pattern that you like that could end up working for you, right? So that's one of the keys also to kind of curating a list and to trying to find plays is sometimes if a chart isn't giving you a play for today or for tomorrow, that doesn't mean it can't give you a play for next week or the week after, right? So you want to keep that on your watch list. That's what the watch list is for, is to keep watching names to see if they print the patterns that you want. And if you miss them, well, then maybe they give you some kind of other play in the near future, right? So not saying to discard this. I think this is it's at good support, and it's trying to establish a nice bottom here. So maybe it prints something better in the near future that we can kind of go ahead and play off of. Okay. All right. We got 5 more minutes. If someone else has a chart request, feel free to put it in. If not, I'll go ahead and call it already. We've had a nice discourse today, and we went over quite a few things. So let me know if anyone else wants me to look at something. Feel free to put it in. If not, then I think we can pretty much end it. All right, guys. Oh, round one more. All right, CCI. Crown Cap. Oh, this is nice. This is pretty strong. All right. So I'm not sure whether you're in this or not, but as far as entries are concerned, I think it's too late to enter this as well. I like this. I think it's a very strong chart. It's doing very well. Obviously, you can look at the weekly chart, and it's a name that just rallies all the time, right? So this is a great name to go ahead and keep watching. But you're in it. Target. All right, this is going to be an easy one, and it's going to be a hard one. Target is unspecified. Are you in this for the long term, or are you in this for the short term? Because this name just keeps going up and up and up. January calls, January of next year. Okay, so you do have, all right, so you have a time frame that you're looking at. There is no target because it's at all-time highs. So what I would suggest in this situation is just trail a stop. I mean, this thing, it just goes up, right? So there's really nothing that I can tell you is a target because I would just be making something up, right? And a lot of times what people do in these scenarios is they say, well, what the measured move is on something, right? Which I don't even think there's a measured move. Or some people say, well, we'll do a Fibonacci extension of that, something of that nature. But I don't think that's really the case here. I think what you want to do in something like this is just trail a stop. Not sure what your goal was when you started the trade, but it keeps going up, right? So what I do in these scenarios is I just trail a stop. A lot of times now I do scale out, right? And so this goes back to what I was mentioning earlier, which is so it looked like a cup and handle to you, and it did kind of have a cup and handle sort of a play to it, right? So we had. So that was the cup and the handle, right? And that was, yeah, it basically did. It had 2 cup and handles actually too, because you could look at this as a cup and handle as well, at which point it failed. But then in the larger scheme, it still did kind of a cup and handle like that, like this, right? And so you had the nice big move off of that. And some people say when you have a price pattern like this, the extended move is basically you look at the height of the pattern, and then you go ahead and you measure it. That's the measured move, which would mean theoretically right around now. But again, I don't put a lot of stock into those measured moves because I think that's just, to me, that's kind of mumbo jumbo. That's not what I consider technical analysis. To me, is reading human behavior, and the only real thing I could consider would make sense is this the idea of symmetry in human nature, where If it dropped a certain amount, that's what people would expect it to move. But I don't really put a lot of stock in that as far as when I'm using my technical analysis to figure out targets. So when you're at new highs, I basically say, you know what? It's at new highs. There's really nothing you could define. But there is two underlying fundamental ideas that I have when I'm trading, particularly when I'm trading options, which I know decay in value. And the first is when you have these big, strong green days, right? These range expansion days, volume, price of options gets a little inflated because you have an increase in volatility, right? So a lot of times it makes sense for me to take profits on my options trades on big green days, regardless of whether it's hitting the target that I'm looking for. So from that perspective, a day like today is actually a good day to take some off. Now, to close out the entire trade, usually when the name is this strong, when you have the big move like that, I find that taking part of the trade off helps me be a little bit more calm and comfortable with letting the rest of it run. So a situation like this, if you haven't taken any profits yet, normally what I do like this is I take part of it off, maybe a third, and then I trail more. And what I do is I'll trail it based off of, you could draw a trend line, you could just play off of the pivots and wait for it to establish a flag, and then set that as your new stop out point, and try to let it continue. Or you could use the moving averages, maybe the 20, maybe even like something really fast like the 9-period moving average, and just try to trail it as high up as you can before it eventually rolls over on you. And then you won't get the high, but you could end up getting a much bigger sustained move depending on how long it plays out, right? So that's what I'd say on this one. You know, there's really no target because it's at highs. So what you want to do in that case is basically manage your own emotions the best you can, right? So if you're antsy and you want to take some off, take some off. If you want to close out the whole trade, you could, but I think it's probably better to take out half or a third, and then trail the stop on the rest and see if you can get more out of it. Okay? All right, well, that covers it. Thank you. Ron and Wes, thank you for adding some stocks. That obviously helps me fill some time and gives me something else to talk about, and gives me a better, sometimes it's easier to elaborate and to give more sort of, I guess, teaching or advice on technical analysis when I look at the charts you guys are looking at, rather than trying to pick one of my own. So thank you for your participation. I want to thank those of you that attended. I see a couple of new names on here. Hopefully you guys enjoyed what you saw. If you did, please follow me on Twitter. That way you'll know anytime I have one of these. I always put it on Twitter first. Again, it's just Stock Darts at Twitter. And hopefully I'll see you guys again next Wednesday. Have a good rest of this week and weekend.